Good morning and welcome to Bazaar Morning Call. I am Anuj from our New Delhi studios, and of course, joining me from the Mumbai studio, we have Sonia and Prashant as always. Sonia, Prashant, good morning. You know, what a strong day we had yesterday for the market, not just in terms of the price action, but the vote of confidence that is there in the Indian market once again. The dip getting bought and how, especially in the bank Nifty, and the decoupling theory is now getting stronger by the day. We all have the numbers now and how Indian market has really been the best performing market on all time frames. And the bank Nifty, well, what can you say about that? What a leadership from that index. Weekly options expiry today. The momentum is firmly with the bulls. The STX Nifty is indicating that we'll once again reclaim that 18,000 mark and actually trade above that. Let's see how things move. Sonia, Prashant, hi, good morning.
Hi.
Good morning, guys.
Morning, Anuj. Morning, Prashant. Absolutely. I mean, this market, right, the Indian market is bulletproof. I mean, there's no other way to put it. Just look at what's happening across the globe in our own markets. Every dip is getting bought. And as you said, the star of the show yesterday undoubtedly was the Bank Nifty, Anuj. 1,100-point intraday recovery is what we saw in the Bank Nifty. There was quite a bit of delivery-based buying that we saw in a lot of the larger banks. In fact, it was not just banks. It was the domestic consumption piece. There was FMCG. There was cement stocks, which saw big buying interest as well. So we'll keep an eye out on that. Global markets didn't do much. There was barely a 30-point move that we saw on the Dow. There's a raft of economic data that comes out later today, so all eyes will be on that. Retail sales, import prices, jobless claims, and these are the last few data points that we get before the Fed policy. Of course, the Fed may have already taken into consideration the data and decided what it plans to do. The base case expectation still remains a 75 basis points rate hike. For our own markets, though, after many days of buying by FIIs, we saw a sell-off yesterday, almost 1,400 crores of selling. DIIs bought a tad bit, about 200 crores. But, you know, this market is so insulated from all the global challenges that Anuj, one wonders whether, despite everything, whatever the outcome of the Fed, will this market continue to chug along? That's the big question now, because not just the headline index, which has been resilient, but there's so much buying in themes, right? Whether it's consumer durables, home improvement, real estate, defense. These themes are really delivering big gains.
You know, Sonia, we'll remember we were discussing this in Editors Roundtable. The point I keep making, don't watch SGX Nifty or the Dow in the evening. You know, because the Dow is getting impacted by its own news, like Tuesday evening, and you saw what the market did yesterday. And the kind of money which has been chasing stocks, the banking, consumption, autos, and I think these are the themes which continue to do well. The only risk in this market is to stay out or book too soon. Yes, the market will give you days like yesterday when it will make you sort of challenge your thesis about whether the bull market is intact or not. But let the market throw you out. I think the market would not have thrown you out if you had kept logical stop loss. You need to keep trailing your stop loss, of course, in a rising market. On Nifty, that level is very sacrosanct now. The 20-day exponential moving average, even yesterday, the market almost tested that and from there bounced back. That level is somewhere around 17,650 to 17,700 now. So as long as that's holding, every dip, small or big, has to be lapped up with both hands. And really, in a bull market like we have, yesterday's dip was that full toss that should have been dispatched. Now, on the bank Nifty, the problem is that while yesterday was a good risk reward, now you are in a parabola. And I don't know how you enter that, because if you want to chase it on weekly options expiry day, as a day trader, sometimes it can be risky. The best entry zone is between the 5 and 10-day exponential moving average, which is somewhere around 40,260 to 40,730. The market was charitable to give you that dip yesterday. I don't know if there'll be another dip, but normally in markets there are. So, you know, you maybe want to wait for that if you haven't been already in the bank Nifty, that is. Now, what is very interesting is the FI data in the futures and options market, where FIs are still short. In fact, yesterday they added another 20,000 shorts, and now their short exposure is at about 74%. So again, this is a market where there's a bit of a disbelief, there's denial, but the market keeps moving on. Now, this rally also explains that this has been a rally which is a bet on the Indian economy. It's got nothing to do with what the dollar index is doing, what the Fed might do. The Fed might raise rates by 100 basis points, and our market will move on. Because the bet has been taken on the economy-facing stocks. The bank Nifty is leading it. All other domestic sectors like autos, consumption, FMCG, they are doing well. And once again, you saw IT, for example, after the two-day rally, once again retreated. So the IT rallies would be bear market rallies, which might mean exit opportunity. But for the rest of the domestic economy sectors, every dip, small or big, is a buying opportunity. Prashant, hi, morning. What do you have for us?
Anuj, the objectives we run out of, right? I mean, resilience and outperformance and all. But I'll tell you this, if you're trading, there is an old saying, right? It's never as bad as it seems, but it's also never as good as it looks. I mean, on both sides, people tend to overdo things. When the market's correcting, well, there is no tomorrow and it's going to go down even more. When the market's going up, it'll just keep heading higher and higher. It's just what momentum does to people, to our brains. You can't sort of seem to look otherwise, right? I mean, when you're in a strong uptrend or a downtrend, the impulse is to believe that this will continue and there will be no end in sight. So with that caveat, with that one-liner, let me just quickly put out a couple of points. So the outperformance, of course, is there for all to see on all time frames. I mean, on a day-on-day time frame. The S&P was down 4.3% on Tuesday. Yesterday, the market here lost just about 1/3%. I don't remember the last time we saw this kind of, big difference. Year to date, I'm talking about time frames. Look at the performance. The S&P is down 18%. The Nifty is up almost 4% or so. So this is quite incredible. Now, what is going well for us is the fact that commentary from corporates is seeming very, very optimistic. And that does bode well for domestic earnings growth. A lot of domestic-facing sectors can benefit if domestic demand is strong, as the commentary indicates. At the same time, I remember this, I think Credit Suisse a couple of years back put out a report, about 50% of earnings, Nifty earnings, are global in nature, right? So if the globe does slow down quite a bit, I think, you got to basically expect no help from global markets and, global macros in that sense. And that is, you can't brush that aside completely. You've got to stay cognizant of that. You've got to be aware of that as well. Financial conditions will continue to tighten globally, as we've seen after the CPI. I mean, they've tightened incredibly powerfully after the Jackson Hole speech and, of course, after US inflation as well. And that's the fountainhead for money globally, right? Dollars globally, the US Fed. And they're going to tighten. So I think that is, so basically local commentary and expectations and hopes are high, but the global picture is going to stay troubled for obvious reasons, as we've been highlighting. As a consequence of all of this, if the inflows continue and consequently if the rally continues, it will have to be a very India-specific one. I mean, it's not a broad global risk on. It will be very deliberate India-specific moves that we will see if we are to see a continuation of these big moves that we are seeing at this point in time. I mean, time frames matter if you're trading, if you're investing. But I think for both, one thing is very clear, starting points matter. So in that sense, a risk reward, Anuj, as you also highlighted, I think becomes very, very important, especially if you're trading. I mean, if you've got time on your side and you're long term, I mean, you can kind of weather some of these blows and drawdowns, which are natural, which are par for the course when you are investing. But if you're trading, especially if you're on the futures and option side, etc., entry points matter. I mean, I think that becomes the primary, at least the primary thing to start with as you do all of that. So I think that's my short piece. But as I said, I would sort of wrap up this piece with one more thing, that there are, as they say, there are old traders and there are bold traders, but there are very few old and bold traders. I mean, it's just percentages. So keep that in mind. If you're trading, especially, if you're investing, if you've got time on your side, it becomes a little more easier. Not very easy, but a little more easier. Sonia.
We had this very interesting discussion with Simon Powell yesterday, and he was talking about how the Gen Z, right, the new generation, is now getting big into not just investing, but even into consumption, etc. And India has the largest population of Gen Z in the world. So the kind of money that's also coming in from the younger generation has picked up dramatically, especially post the pandemic when people have opened their demat accounts. And in the markets, we're seeing this, at least this month, we've seen a big pickup in consumption stocks, domestic consumption names. So whether it's Shree Cement, whether it's Bajaj Finserv, ITC, Tata Consumer, SBI. These are all domestic-focused companies that are catering to this whole consumption theme. All right, let's do one thing. Let's kickstart the show. The SGX Nifty is bright and chirpy this morning, indicating a 50-point bump up. Here's our first comment for the day. We have a view coming in from Vikas Jain of CLSA, who says that the last 3 months have seen a cool-off in oil prices and yields, which has fueled a strong 20% rally. But this benign macro setup may change, as big global events over the next 3 months could force investors to take a fresh stance on important macro debates like a US recession, inflation, geopolitics, China's COVID lockdowns, commodity prices and Indian consumption demand. With Indian equity valuations in the top 10 percentile on absolute and relative basis, they are uncomfortable about equity returns going into these big macro events.
All right, Gautam Dugat of Motilal Oswal says that India's earnings cycle has seen a turnaround after almost a decade and continues to remain healthy amid the current adverse macroeconomic scenario, with heightened worries about rising rates, elevated oil prices and liquidity tightening that has kept the market volatile and jittery. They estimate FY 22 to 24 profit after tax CAGR of 17%, led by banking, financial services and automobiles.
Okay, let's also try and get you some money market views for the day, because there's plenty happening in that world. On the rupee itself, we have Parul Mithal Sinha of Standard Chartered Bank, who says that the rupee has continued to outperform EM forex markets despite persistent dollar strength post Jackson Hole and the US CPI data. The US dollar sales by PSU banks, FPI inflows and oil prices at sub-95 levels have supported the rupee. Expect to see the dollar INR trade in the 79.25 to 79.75 range this week.
Well, on the bonds, we've got Parul Mithal Sinha, who says that rates market has been relatively well supported vis-a-vis global rates and sustained hopes around index inclusion. The INR yield curve has flattened sharply in line with global trends. They expect the 10-year yield to trade in the 7.08 to 7.18% range next week, with developed market central banks front-loading large rate hikes. Market expectation for the upcoming September policy has moved to 50 basis points.
Okay, there are plenty of stock-specific, trades today, or action today. Actually, we'll get to that in a bit in our special top 10 segment. We're looking at Balaji Amines, KPI, Green Energy, there's KC International, there's Home First Finance, Aditya Birla Capital, ONGC and Oil India. These are stocks on our radar on the back of positive news flow. And then on the negative side, there's PVR, Sundaram Fasteners and GR Infra projects that are likely to open in the red. But let's also get you some opinion now, with the US seeing inflation coming in higher than expected in August and the Fed meeting now scheduled for next week. All eyes will be on what the Fed does and what the reaction will be of risky assets like equities.